Welcome to Unfiltered Finance. If you're tired of the financial illusions and ready for the brutal math, you are in exactly the right place. Let's dive in. Welcome to Unfiltered Finance. If you're tired of the financial illusions and ready for the brutal math, you are in exactly the right place. Let's dive in. Imagine working for 40 straight years. You wake up early, you build a career, and you pay a 40% or even 45% income tax on everything you earn. You pay a 20% value-added tax on every single item you buy. You pay heavy stamp duty when you finally manage to purchase a family home. And of course, the government takes capital gains tax when you invest your leftover pennies. But you sacrifice, you save, and you build a legacy for your children. Then comes the day you close your eyes for the last time. The struggle is over. But the moment you are gone, the government steps in for one final cut, a staggering 40% confiscation of your life's entire work. In the United Kingdom, this brutal mechanism is called the inheritance tax, or IHT. Let's look at the numbers. In the 2023 to 2024 tax year, HMRC collected a record-breaking £7.5 billion from grieving families across the country. That is a £400 million increase from the previous year. And the trajectory is only going straight up as asset prices artificially inflate. To the unprepared middle class, the 40% death tax is a devastating wealth wipeout. It forces the forced liquidation of history, selling childhood homes. But to the upper class, the aristocracy, operating like a private family office, paying this 40% tax is completely, strictly optional. They don't leave their wealth exposed in open fields. They build legal fortresses, trusts, SIPPs, and offshore havens. The Duke of Westminster inherited a £9 billion estate in 2016. Do you know how much inheritance tax he legally paid? Almost zero. How is this mathematically possible? Because the upper class understands a fundamental rule. They do not own assets, they control them. In this deep dive, we are going to unpack the exact architecture of a generational wealth fortress. We will show you how to think like a family office, protect your portfolio, and ensure the taxman stops at the gates. Let's begin. Inheritance tax was never designed to crush the working middle class. When it was originally introduced back in 1894 as the estate duty, it was a targeted wealth transfer mechanism aimed squarely at the ultra-wealthy aristocracy. But today, the aristocracy and the ultra-wealthy rarely pay it. Instead, the modern inheritance tax has become a trap for doctors, engineers, and small business owners. How did a tax for billionaires become a tax for the middle class? Two words: fiscal drag. In the UK, everyone is granted a standard tax-free allowance called the nil-rate band. This allowance has been frozen at exactly £325,000 since the year 2009. While the threshold has remained completely paralyzed, UK property prices have surged over 70% during that exact same period. Even if we factor in the additional residence nil-rate band of £175,000, bringing a married couple's total potential tax-free allowance to exactly £1 million, it is still an inescapable trap. If you own a modest, semi-detached house in London, along with a standard lifetime pension, your estate is already deep in the red zone. Everything above that arbitrary frozen line is brutally taxed at exactly 40%. The simplest yet most unforgiving shield against the 40% death tax is time itself. HMRC has a specific provision known as potentially exempt transfers, or PETs. The mechanism is straightforward. If you gift a portion of your wealth directly to your children, and you manage to survive for exactly 7 consecutive years from that date, that entire gift becomes completely, 100% free of inheritance tax. It legally falls outside the boundaries of your taxable estate, but it is a gamble. Die in year 3? The government still takes their full 40% cut. Survive to year 6? The tax rate finally begins to taper down to just 8%. It is quite literally a mathematical race against human mortality. However, a true upper-class family office doesn't just hand over cash and hope for the best, because handing a young 25-year-old heir a sudden windfall of £1 million is a highly efficient way to ensure that money quickly disappears into fast sports cars and terrible impulsive business investments that evaporate the family's legacy. That is exactly where the true architecture of generational wealth structuring comes into play. You do not give them the money, You give them the beneficiary rights to an impenetrable fortress. Here at Unfiltered Finance, we often see families completely overlook the most powerful vehicle in the UK system, the discretionary trust. When you place your assets into this legal structure, you legally no longer own them. The trust does. While there is an immediate 20% entry charge for amounts transferred over the £325,000 threshold, paying it completely removes the underlying asset from the brutal 40% death tax upon passing. The wealth then grows inside a protective shell, governed by trustees who distribute it based on your exact rules. But what if you want to keep the wealth while you're alive? Enter the SIPP, the self-invested personal pension. In the UK system, pensions sit entirely outside your taxable estate. You can proactively build a £1 million SIPP, invest it globally, and if you pass away before age 75, your heirs inherit the entire portfolio completely tax-free. If you die after 75, they only pay their marginal income tax rate when drawing. The pension in this scenario isn't just for retirement, it is a generational vault. But shielding the wealth from taxes is only half of the battle. You must also actively shield it from the violent fluctuations of the market. Upper-class families don't leave their cash decaying in a standard bank account, where it is slowly and silently eaten alive by 4% annual inflation. Instead, they proactively shift their liquid capital into financial fortresses known as safe havens. We are talking about robust global ETFs and heavy physical gold bars and highly liquid money market funds. When the Bank of England manipulated the UK gilts market back in 2022, smart family offices had already anticipated the crash. They moved their liquidity into US dollar-denominated short-term treasury ETFs, yielding 5.3% risk-free. By utilizing a legal wrapper like an offshore bond or an ISA for smaller amounts, they ensure the capital grows securely. But more importantly, the invisible tax drag on the compounding interest is completely minimized. The mathematical reality is shockingly simple. A 6% return compounded tax-free over 30 years absolutely destroys a 10% return that is taxed heavily every single year. So, trusts protect the legacy, SIPPs act as tax-free vaults, and safe havens protect purchasing power against inflation. But what about owning actual active businesses? The UK government generously offers business relief. If you own a trading business for at least 2 consecutive years, it is 100% exempt from inheritance tax. But here is the brilliant, perfectly legal loophole the wealthy use: the alternative investment market, commonly known as AIM. Buying shares in certain qualifying unlisted companies on the AIM exchange qualifies for this exact same 100% tax relief after just 2 years. Let's look at a brutal case study. 2 families, each starting with exactly £5 million. Family A leaves their wealth entirely in standard properties and decaying cash accounts. Upon passing, HMRC steps in and violently takes £1.6 million. Family B, however, acts like a family office. First, they totally max out their SIPPs. Then they systematically place a structured £1 million into a discretionary trust. And finally, they invest their liquid £1 million into an AIM ISA portfolio. Family B's final inheritance tax bill? Nearly absolutely zero. The massive difference isn't luck. It's simply structural engineering. When a family isn't prepared, the emotional toll is absolutely devastating. Thousands of hardworking UK families are forced to sell their childhood homes. Homes filled with decades of irreplaceable memories, just to generate the massive liquid cash needed to pay the HMRC. And they must do this within a strict, unforgiving 6-month deadline. It is nothing less than a forced liquidation of personal history. As we constantly analyze here at Unfiltered Finance, when domestic taxes become overly punitive, capital doesn't stick around. It simply books a flight. The famous non-dom tax status is currently undergoing massive political changes in the UK, pushing the ultra-wealthy class to completely expatriate their families and their assets. They are aggressively moving to jurisdictions like Dubai, where there is currently zero income tax and absolutely zero inheritance tax. Or they relocate to Switzerland, utilizing the highly efficient lump sum taxation system. Because at the end of the day, capital goes where it is treated best, and it stays where it is protected. But make no mistake, the government is constantly trying to close these very loopholes. Political winds shift rapidly, and new aggressive budgets consistently threaten to slash the generous business relief or heavily tax those protected pension vaults. Because of this constant threat, the ultimate defense isn't just a static legal structure. It is a deeply ingrained, unbreakable generational mindset. The old aristocracy understands a profound, fundamental truth that the middle class ignores. You do not truly own the wealth. You never did. You are merely its temporary steward for the current generation. Your only job is to grow it, violently protect it from the taxman, and smoothly hand the keys to the next prepared steward. A true family office isn't just a highly paid accountant. It is a living family constitution, bound by strict internal laws. It proactively teaches the young heirs essential financial literacy, the silent, compounding brutality of annual inflation, and the inescapable mathematical reality of government taxes. In the end, the 40% death tax is fundamentally a voluntary tax, paid only by those who completely fail to prepare and plan. Whether it's mathematically utilizing the strict 7-year gift rule, legally structuring a protective discretionary trust for your heirs, aggressively maxing out your tax-free SIPP retirement accounts, or packing up and relocating entirely to Dubai, protecting your life's work simply requires actively thinking decades ahead. You owe it to the immense sacrifices you made, because the brutal mathematical numbers absolutely do not lie, but they only financially reward those who pay attention. If you value the brutal truth over financial illusions, then hit subscribe today. To see how this math applies to your next move, click the video on your screen. I will see you there. Disclaimer: this video is for informational and educational purposes only, not financial advice. All investing carries risk of loss. Consult a licensed advisor before deciding.